If you want to build real wealth, if you want to consistently align yourself with the market's big directional shifts before they unfold, you need to understand the psychological dynamics that actually move prices. You can't just rely on what others believe or say. You can't just react to news or opinions. You've got to understand how your perceptions, expectations, and beliefs interact with the market's collective behavior. That's where real opportunity begins. Now, let me ask you something. When you see a chart moving, do you ever stop and think about what that movement truly represents? Not just that it's going up or down, but why it's moving that way. What emotions, what belief shifts are creating that change in order flow? Because if you don't understand that, you're not trading objectively, you're projecting. And projection isn't a strategy. Big market movements, the kind that generate wealth, emerge when collective beliefs shift decisively. When enough participants act on the same conviction, imbalance forms. If you can recognize those psychological shifts as they start, before the masses react, that's where probability tilts in your favor. Here's the thing. Most people fixate on external information, headlines, reports, announcements. But by the time that information reaches you, the traders who move size have already acted. They don't wait for certainty. They operate on probability, on subtle signs of change in conviction and emotion. They read the market's underlying rhythm, the shifts in confidence, in optimism, in fear. That's what you need to learn to perceive. Think of the market as a mirror, not a machine. It reflects collective human perception, millions of beliefs, hopes, and fears interacting at once. Price is simply the visible output of those unseen psychological inputs. If you can read the energy behind price, the intent, not just the movement, you begin to see what's truly happening beneath the surface. Now let's talk about charts. Some people dismiss technicals as lines and patterns, but what charts really capture is the human mind in motion. Every candle, every bar is a snapshot of emotional energy: fear, greed, uncertainty, conviction. When you learn to see that emotional rhythm, you can sense when pressure is about to shift. Take volume, for instance. Volume is participation, and participation reflects conviction. If price moves without conviction, it's fragile. But when price expands with commitment, that's alignment, belief made visible. And belief leaves footprints. You follow footprints to understand where the crowd's emotion is headed, not because you know what will happen, but because it gives you an edge in probability. Structure is another form of collective psychology. Markets move between expansion and contraction, between emotional extremes and balance. A range is simply a buildup of conflicting beliefs waiting for resolution. Think of it as tension in the crowd's expectations. The longer that tension builds, the stronger the emotional release when it breaks. And when you learn to recognize that moment early, before the mass belief shifts, that's when opportunity expands. But here's the challenge. Most traders get caught in their own emotional reactions. They see movement and feel the need to act, chasing certainty that doesn't exist. They confuse activity with control. But the market doesn't reward certainty seekers. It rewards those who can act without needing to know. That's why mindset is everything. Let me ask you this. When you lose a trade, what story do you tell yourself? Do you blame the market, or do you see feedback about your perception of probability? Because if you externalize losses, you give away your power. But if you internalize them as lessons in belief alignment, you evolve. Building wealth as a trader isn't about catching every move. It's about maintaining mental alignment with the probabilities that favor you. That means patience, waiting for setups that resonate with your belief in your edge. Like a hunter who only acts when conditions align, you wait until the probabilities line up and then execute without hesitation. To sense those moments early, start by stepping back. Higher time frames show the market's collective mood, the prevailing belief system. Then, as you move into lower time frames, you're simply syncing your execution with that broader context. The mistake many make is focusing only on the noise, reacting to randomness, and losing touch with the dominant emotional flow. Big market moves come from aligning with that larger emotional current, not fighting it. If the broader market belief is optimistic and a smaller pullback occurs on low participation, that's hesitation, not reversal. It's where fear momentarily outweighs conviction before confidence returns. And that's often your moment of edge. Do you see how this is about reading probabilities, not predicting outcomes? You're learning to observe without bias, to recognize when the odds shift slightly in your favor. Each signal, price, volume, structure, is a clue, and when multiple clues align, your belief in your edge strengthens. Over time, that consistent application of probabilistic thinking compounds into real results. That's how trading becomes a process, not of guessing, but of aligning your beliefs, behavior, and actions with the nature of uncertainty itself. If you had the discipline to focus only on a few high-probability opportunities each year and manage them with consistency and composure, how different would your trading results look? Would you still feel the compulsion to chase every tick, every minor move? Or would you finally allow patience and trust in your process to guide you? Because ultimately, the market doesn't reward activity. It rewards psychological stability, discipline, and understanding of probabilities. And the sooner you internalize that, the sooner you separate yourself from the reactive majority. Charts are footprints of collective belief and emotion. Learn to read them, and you're really learning to read yourself. That simple idea captures one of the deepest truths about markets. Yet most traders ignore it because they're lost in surface-level data. When you see a chart, what you're truly seeing is not just price, not just numbers. It's the collective mental and emotional state of participants, all acting from their unique combinations of fear, hope, and expectation. Every candle is a psychological record. Hesitation, greed, confidence, doubt, all expressed as price movement. If you can learn to interpret that emotional dialogue objectively, you'll see shifts in conviction long before they manifest in headlines or opinions. Think about what drives behavior. On the way up, traders are not simply buying. They're expressing growing confidence. Their belief that the market will reward them amplifies. The fear of missing out, which is still fear, propels them to act impulsively, often at poor prices. On the way down, that same energy reverses. Confidence dissolves into panic. The fear of loss becomes so intense that traders exit positions at any cost, just to silence the emotional discomfort. Charts reveal this collective oscillation between confidence and despair, a strong trend with expanding range and participation. Is confidence spreading through the crowd? A violent drop on heavy volume is pure capitulation, the emotional release of fear. Now ask yourself, when you see a breakout on a chart, do you only see a technical level being breached? Or do you sense the underlying emotional transition, the moment when uncertainty flips into shared conviction? Behind every breakout is a crowd finally giving itself permission to believe. That shift from hesitation to action is visible energy, the market's emotional pulse recorded in price. When you start viewing charts not as rigid patterns, but as evolving maps of crowd behavior, you begin to understand why the same formations repeat decade after decade. Human psychology doesn't evolve nearly as fast as technology does. That's why levels of support and resistance matter. Not because of geometry, but because of memory. They're psychological landmarks. Picture the traders who bought at a certain level only to watch price drop. They feel regret, frustration, even embarrassment. When price returns to that zone, they're eager to exit at break even to ease that discomfort, creating resistance. The opposite happens with support. Those who sold short too soon feel the sting of being wrong. When price revisits that level, they rush to cover, creating demand. There's no mystery in this, just the predictability of emotional pain and relief expressed as market structure. Volume 2 is an emotional barometer. Price movement without participation is a whisper. Movement with conviction is a shout. And when you see expansion in both price and volume, you're witnessing collective belief gathering force. When price drifts higher on diminishing volume, you're seeing the enthusiasm wane, greed stretching beyond conviction. Volume reveals the intensity behind behavior. It's how you gauge whether emotion supports the move or contradicts it. Patterns, head and shoulders, flags, triangles, aren't random decorations. They're recurring emotional signatures. A flag forms when conviction pauses. Traders take profits while others wait for more certainty. When uncertainty resolves, confidence surges again. That's not geometry. It's emotion cycling through the crowd. Long consolidations represent deep indecision, a market caught between belief systems. Buyers and sellers test each other, waiting for a collective decision. The longer that tension persists, the more powerful the breakout when it resolves, because it represents a mass emotional release. You won't find this understanding in news headlines or reports. You'll only see it when you look at charts as emotional landscapes. Even false breakouts tell a story. They expose how the market manipulates collective perception. Price pokes through a level, triggering greed and urgency. The inexperienced pile in, certain of continuation. But professionals, detached and prepared, use that burst of emotion to exit. When price reverses, the crowd feels trapped. Fear takes over, and the market inhales their liquidity. This dynamic repeats endlessly because human emotion repeats endlessly. You might ask, if markets are supposed to be efficient, why do these emotional footprints even matter? Because efficiency doesn't eliminate psychology. It simply integrates it over time. In the short term, perception and emotion dominate. In the long term, balance returns. But traders live and act in the short term, and that's where an understanding behavior provides edge. That's why the most consistent traders rely on pure price action, not as a system of prediction, but as a mirror of crowd psychology. They're constantly asking, what are traders feeling here? Who's trapped? Who's in control? Where is pain accumulating? When you analyze a chart through that lens, you're no longer guessing. You're building a probabilistic narrative grounded in behavior. Think about those sudden spikes on the chart. They often represent emotional exhaustion, forced liquidations, stop hunts, margin calls, fear at its peak. And right after that emotional climax, the pressure releases and reversals occur. Charts show this cycle of contraction and relief, fear and confidence, tension and resolution. Greed, on the other hand, builds slowly, a gradual expansion of comfort and complacency. You'll see smooth climbs, small dips quickly bought, confidence increasing until no one questions the move. Then suddenly, when everyone believes in one direction, the market turns. Not because of logic, but because belief has reached saturation, and there's no emotional energy left to sustain it. That's greed reaching its psychological peak. And again, the chart tells the story, not through prediction, but through emotion displayed as data, divergences, fading momentum, heavy volume at the top, all reveal when conviction has turned into overconfidence. This is why discipline matters in reading charts. It's not about knowing what will happen. It's about recognizing what's likely to happen. When you sense collective euphoria, you understand that probabilities are shifting. Confidence has reached excess, and the likelihood of reversal rises. When fear dominates and capitulation unfolds, the probability of recovery increases. You're reading emotional footprints and adjusting your expectations, not trying to outguess the market, but flowing with its psychology. The deeper you internalize this, the clearer it becomes that markets aren't lifeless numbers on a screen. They're a living, breathing reflection of collective perception. That's why the same emotional signatures, the same patterns, reappear decade after decade, across every asset class. Human emotion hasn't changed in thousands of years, and as long as humans trade, their collective responses will remain etched in the charts. When you train yourself to see beyond the superficial, you develop a feel, an intuitive recognition for what's genuine and what's noise. You stop reacting impulsively and start waiting patiently for alignment between fear and greed. That's how you anticipate large directional moves, not through hope, but by observing probabilities unfold in human behavior. Higher time frames reveal the dominant emotional current. Lower time frames let you fine-tune your participation. It sounds simple, but it's one of the most psychologically powerful principles a trader can master. Most traders dive straight into the smallest time frames because they crave stimulation, the illusion of control through constant engagement. 5-minute candles, 1-minute ticks, endless motion, endless reaction. But in truth, that fixation on speed traps you in randomness. When you operate solely inside micro-movements, you lose the ability to distinguish meaningful structure from emotional noise. Consistency evaporates when your reference frame is chaos. Think of it this way. If you were navigating an ocean, would you focus on tiny ripples in the water, or first study the map that shows the coastline? You'd start with the map, the big picture. In trading, higher time frames are that map. They show you the underlying direction of belief, the trend that defines the psychological climate. Once you understand that, you can drop to smaller time frames to synchronize your execution. Precise timing built on context. Without the map, you're just reacting to waves you don't comprehend. Look at a weekly chart. Each candle captures the emotional battle across thousands, sometimes millions of transactions. The patterns that emerge there represent conviction that transcends momentary noise. A breakout on a weekly chart carries vastly more meaning than one on a 5-minute chart because it reflects belief shared by far more participants. That's why professional and institutional traders always begin with the broader view. They align with the collective flow of capital, not with the impulses of the moment. When you study the daily chart after grasping the weekly structure, you start to see how that larger sentiment manifests. If the weekly shows higher highs and higher lows, a sustained uptrend, then the daily often reveals pauses, pullbacks, consolidations. These are moments of hesitation within conviction. When you recognize them, you're seeing opportunity, small emotional contractions inside a greater wave of belief. That's where you position yourself in harmony with the tide, not against it. And that distinction, acting with the emotional current instead of resisting it, determines whether your results compound or collapse. Refinement comes when you blend multiple time frames into one coherent picture of probability. Once the weekly defines the trend and the daily shapes the structure, You can drop to a 4-hour or 1-hour chart for precision. That's where you wait for confirmation, a shift in momentum, volume alignment, or resolution of consolidation to execute with clarity. Each layer reinforces the next. You're stacking probabilities, not chasing certainties. And in the world of trading, probabilities are everything. Do you see how this structure protects you from emotional errors? Many traders get excited about a small breakout on a 15-minute chart, unaware that it's colliding directly into a major resistance visible on the daily. The move fails, and they call it manipulation. But it's not manipulation. It's misalignment. Others panic during a brief pullback on a 5-minute chart without realizing it's a tiny retracement within a powerful weekly trend. They exit prematurely, losing faith in an otherwise valid trade. Context provides perspective, and perspective keeps emotion from hijacking your process. There's something profoundly psychological about using higher time frames. They force you to slow down. They rewire your relationship with uncertainty. You stop reacting to every tick and begin to see movement as part of a broader emotional wave. You start understanding that genuine wealth creation in markets doesn't happen in minutes. It unfolds through patience, through the compounding of well-aligned probabilities across weeks, months, and sometimes years. This shift in perception transforms your approach. You stop chasing the illusion of constant opportunity and begin aligning with the few meaningful ones that truly matter. Imagine this. You study a weekly chart and see a market building a base for months beneath a significant resistance level. Volume is rising steadily, and momentum is strengthening, conviction quietly building. On the daily, you notice higher lows pressing into that level, buyers becoming bolder. Then on the 1-hour chart, you spot a breakout supported by participation. That's your moment. You didn't guess, you aligned. You acted with structure, not impulse. Now compare that with the trader who only watches the short-term chart. They see the breakout, buy in with excitement, unaware that a massive long-term resistance sits just above. Price hits that wall, reverses sharply, and they're stopped out. Frustrated, confused, convinced the market is unfair. But the market isn't unfair. Their perspective was. They mistook randomness for signal because they never zoomed out. The same principle applies in reverse. Suppose the weekly shows a long-term downtrend, a clear pattern of lower highs and lower lows. On the daily, there's a minor bounce, and on the 1-hour, it looks like a promising breakout. Without context, that setup looks appealing. But when you remember the dominant trend, you recognize it as a counter-trend rally, a short-lived emotional relief. The probability favors failure, not continuation. Aligning your trades with the larger emotional tide is how you avoid getting swept up in false optimism. Ask yourself this: do you want to move with the market's emotional current or constantly against it? If you were surfing, would you paddle into the wave or ride with its momentum? The answer is obvious, yet many traders fight the larger flow because they crave the illusion of control that comes with activity. But fighting the tide, both emotionally and technically, is exhausting. Aligning with the broader market rhythm is far more sustainable, not just technically, but psychologically. This same principle extends naturally into risk management. When you're trading in harmony with a higher time frame trend, your risk parameters become logical rather than emotional. You can define your stop loss with structure and context, beneath meaningful support or above legitimate resistance, rather than in arbitrary places born from fear or hope. That allows your trade the breathing space it needs to unfold, while keeping your decision grounded in the broader emotional framework of the market. You're no longer hoping the market respects your line. You're aligning with where major players, the ones who move the market, are likely to defend theirs. Another powerful truth is that higher time frames naturally filter emotional noise. On a 5-minute chart, every flicker feels urgent. Every wick, every false breakout triggers emotion. It's easy to get caught in a cycle of reaction, fear, and overtrading. But when you zoom out, that chaos resolves into structure. What felt volatile and random becomes coherent and rhythmic. The higher view reveals order, where the lower view only shows tension. And when you train your perception to recognize that order, you become emotionally steady, less shaken by fluctuation, more centered in observation. This is why top-down analysis is not just strategic. It's psychological discipline in practice. You begin by seeing the big picture, the emotional landscape, and then narrow down to execution. It mirrors how true capital behaves. Large participants, institutions, funds, and long-term investors don't base their actions on 5-minute impulses. Their decisions are guided by quarterly flows, macro cycles, and broader belief systems about value and risk. Their behavior leaves traces on the higher time frames, footprints of conviction. When you align yourself with that, you're effectively following the flow of mass confidence, not chasing the noise of emotional amateurs. You're tracking the psychology that drives the waves, not the ripples on the surface. So the process becomes systematic and emotionally freeing. You start with the monthly or weekly chart to grasp the dominant, collective sentiment, the foundational story of where belief is heading. Then you shift to the daily to interpret structure, to locate the zones where emotional pressure is building or releasing. Finally, you refine through the 4-hour or 1-hour chart, where timing meets precision, where you translate understanding into execution. Each step reinforces the next, building a framework of confidence. That alignment across perspectives isn't about being right. It's about functioning consistently in an uncertain environment where probabilities, not predictions, define your edge. Think about what this means for wealth creation. If your focus is only on short-term fluctuations, you might experience moments of success, small wins scattered between frequent losses. But over time, emotional volatility and transactional noise erode your consistency. It's difficult to build lasting results from randomness. However, when you ground your trading in the larger emotional cycles reflected in higher time frames, you're positioning yourself within movements that have the potential to compound. These are not fleeting reactions. They're deep shifts in collective belief that unfold over time. And when you refine your entries at the smaller scale, using precision born from clarity, your risk becomes smaller while your potential expands. That's asymmetry. That's what a real edge looks like, man. Not certainty, but structured probability. You're aligning thought, behavior, and action within a framework that keeps you neutral, patient, and consistent. That's the mindset that turns trading from a sequence of random events into a process of controlled opportunity.